What's up, you guys? It's Janae the Bay, and I'm back again with another video. So this time, it's another Forex video, obviously from the title, but this time we're talking risk management and risk versus reward. So I have my notes down here. When we talk risk management, the number one thing you want to stay focused on is your mentality and what is your motivation going into this. Like for me, my motivation is that I want to have income, sustainable income that I can live off of without having to go to a 9-to-5. And that amount is set for me. And for me, an engineer, the average salary on the low end is $60,000 a year. So that's my goal for each of my side hustles, like whether it's hair or whether it's Forex trading or anything else. I always try to have a goal in mind of what I think I'll be successful, like what's the final stage, what I think is success. And so for me, it's if I can gain 60K a year. So that breaks down to about 5K a month, and then 5K a month divided by 4 weeks a month is about $1,200. So that's what I try to shoot for per week. But obviously, I'm not gonna go from $0 to $1,200 a week. Like, I have to start somewhere. And my first goal is to consistently get 100K a month. So I only say this because you have to think about what you're willing to risk, like what you're willing to gain and what you're willing to risk to gain that. And the other side of the equation is how much you're willing to risk. This should be money that you set aside before. This shouldn't be money that you'll be very sad to lose. This should be money that you are ready to invest in. You wouldn't be too mad that you lost it. And I know that can be a different amount for everybody. As you get better with this, the more money you have to trade with, the more you're able to gain because you have more buffer space for volatile pairs. Volatile pairs will give you the biggest reward if you're able to successfully trade them and profitably trade them. But back to risk management. When you're doing risk management, it's important with different pairs to recognize that different pairs of different magnitudes can give you wider ranges. And when you're trading, sometimes you need to have a certain amount of buffer space. Like 20 pips buffer space sometimes isn't enough if you're not really good, the best at entries. If you're like a sniper entry, then all the more power to you and good for you. But sometimes you do need like a 50 pip stop loss. Sometimes you need a 100 pip stop loss to get that 200 or that 400 pips. I mean, if we're talking day trading or swing trading, which is what I like to focus on because I don't want to have to stare at the chart all day long. So when you're thinking risk management, you have to think about how much you're willing to lose. So for example, if you have a $100 account, say with your $100 account, rule of thumb is you never want to risk more than 6% with a trade. So how do you break that down into, okay, I'm putting this trade in for AUDJPY, what's 6%? 6% of $100 is $6. So on your trade, you're like, okay, how do I put this in the lot sizes? And if I'm willing to risk 10 pips, what lot size should I use? So on AUDJPY, say the price is 0.990, whatever. The 50 pip stop loss, if you use a 0.01 stop, or the 10 pip stop loss, if you use the smallest lot size, 0.01, will come out to 10 cents. So since you're willing to risk $6 and you only have a 10 pip stop loss, you can honestly put in, what is it? A 6 standard? I don't know. Well, it's always different, but you need to recognize, you need to be able to calculate your pips and how much you're actually risking. Because say that you were trying to trade S&P 500 or US 30 with your $100 account, which you probably can't do depending on your broker. I doubt they'll let you do that. I think you need like around a $500 account to trade any of those. At least 300. But you need that much money in your account to be able to trade that because those pairs are extremely volatile. They're in a whole different magnitude. I believe S&P is around 2,500 to 3,000, and US 30 is like 25,000. So when they move, they're moving tens, hundreds, 50s pips, and if your account isn't big enough to cushion that move before it goes into your profit, or say it does go out of your favor, if your account isn't big enough to sustain that, you will probably not have an account for that long, and it'll probably close you out. So it's important to recognize and be able to calculate how much you're willing to risk for each account. And so once you know how much you're willing to risk, you need to be able to optimize your risk to reward ratio. So your risk to reward ratio is basically a ratio comparing how much you're going to risk to how much you're going to get. I believe it goes reward over risk. So if your reward is 150 pips and your risk is 50 pips, your risk to reward ratio is 3. So it's important to optimize that. I believe a good rule of thumb is to always go for a 2 or above, because ultimately you want to try to go for 3 or above, because you can have a risk to reward ratio of 3, 4, 5 and lose 80% of your win or 80% of your trades, but still be in profit. But the important thing is, this is very important. You'll probably run into a lot of problems. All these problems I ran into myself as I was trading, but always keep your lot size the same. Like, no matter what your risk to reward ratio, say you had a 5 to 1, a 6 to 1, and then you had a 1 to 1 that you lost. If that 1 to 1 had a standard lot size and the other ones, all the 4 to 5, 6 ratios had a 0.01 lot size, I guarantee you'll be negative like $100. Like, it makes a difference. So always keep your lot size the same, at least for an extended period of time. And if you're going to change your lot size, keep it that way. But a lot of times people want to like be like, well, this is what I do. I'll start winning, and then I'm like, okay, I want to win more. Let's bump up the lot size. And that one bump up lost, and there goes all the profits. So if that was just a normal lot size like I was doing in the beginning, I would have still been in profit. So it's important to keep these things in mind, and don't let your greediness run away from you while you're trading. And it's important to stay on the demo for a while, because the demo kind of gets you used to putting in trades and not really being too emotionally attached. Because when you're emotionally attached to a trade, a lot of times you'll let the losers ride for way longer than they should, and you'll let the wins not ride long enough. So with a demo, you're not really scared to lose money, because it's not really real money, but it gets you used to like just being detached from the trade and letting your technical and fundamental analysis play out. And lastly, have a plan and a trading journal. A trading journal is where you write down the trades that you took, the setups that you took for the week, and you say, this is what I'm doing, this is why I'm going into this trade, this is why I went into this trade. You can do it after the trade already closed, or you can do it as you're doing the trade. A lot of the times I do it after the trade has closed, because I don't know, it's like a journal entry, and if you won or you lost, you can write down why you won, or why you think you won, or why you think you lost, and if you lost, you have to learn from that trade. Like, you can't, if somebody's gonna take my money, I'm not gonna just let them take it again, because like, I'm like, oh, how did they take my money? Because every time you lose in the market, somebody else is winning. And every time you win in the market, somebody else is losing. So it's kind of like a game of who can guess, because the market is purely speculative. Like, literally, I mean, the big banks run the market, but there's so many retail consumers now, and 99% of them lose. And the goal is to be that 1% who wins. And honestly, you don't even have to win all the time. If you learn good risk management and learn to optimize your risk to reward ratio, you'll be Gucci. So alright guys, that's all I got for this video. If you like this type of content, please like, comment, and subscribe. Don't forget to join the Vibe Tribe, because we're about that money-making entrepreneur business. I don't work for nobody else except myself type of life. And if you like what you see, subscribe. Thank you guys. Hope to see you again. Bye. Blah, 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 blah. Blah. Testing, 1, 2, 3. I need some lip gloss. Continue to check. Oh my freaking goodness. Lastly, what was I gonna say?